Hi everyone, this is Rob and I'm back with another edition of Current News and Analysis. Well, we had some really big news come out late last week regarding the global yield curve. As shown on the Twitter account of Sapientia, the global yield curve is inverting for the first time since 2007 and the Great Recession. Well, what is the global yield curve, or what are yield curves, and why does that matter? Well, for an explanation, we'll turn to Investopedia. An inverted yield curve is an interest rate environment in which long-term debt instruments have a lower yield than short-term debt instruments of the same credit quality. This type of yield curve is the rarest of the three main curve types and is considered to be a predictor of economic recession. So there you go, ladies and gentlemen. One of the biggest predictors of economic recession is now inverting across the world. We're not just talking the United States, we're talking across the world. What does that actually mean in everyday terms? Well, I'm going to give you a video by a professor from George Mason here in a moment in which he'll explain what the potential consequences of that are. But essentially what it means is investors are requiring a higher interest rate on short-term debt issuances than they are on longer-term ones. And this is basically the opposite of what you would expect to happen in a normal market. Normally, the longer term you go out, the more risk there is because there's more uncertainty. We don't know longer term, say 10 or 30 or even 100 years, what's going to happen. We have less control and less knowledge about the factors in the markets at that time because we can't predict the future. And the farther in the future you go, the more uncertainty there is. The more uncertainty, the more overall risk of putting your money into an investment. So typically we see the opposite of this curve. We see it go like this, meaning that the yield goes up the longer term the maturity goes out. So if you're going to hand your money to someone for, say, 10 years, you would want a higher rate of return than you would if you're going to hand it to them for 30 days or 90 days or 1 year. That would be a normal market. What investors are now saying is there's so much uncertainty in the near term, say the next 180 days, 1 year, 2 years, that there's actually more risk in the next couple of years in their mind than there is long term when they have actually less information. This, I believe, 7 out of the last 8 times it's happened has predicted or has happened right before we've had a recession. Only one time did that not happen. There were very special circumstances. So I want to show you this video. It's put out by the Northern Virginia Association of Realtors talking about this very subject, put out recently on May 31st. So you can see the commentary start to come out, by professionals and by the market as we approach this yield curve inversion, and we've been approaching this for the last several months. But I want you to watch the explanation from this professor from George Mason because we're going to examine that here in a moment with some data.
Hi, my name is Ryan Conrad, CEO of the Northern Virginia Association of Realtors, and I'm here with Dr. Terry Clower of George Mason University Center for Regional Analysis for our latest edition of what we're calling Market Minutes. And today we're going to talk about a topic that may be of interest to not just our realtors, but also to their clients. We're going to be talking about interest rate spreads and in the inverted yield curve. Something that you may not be as familiar with, but we felt was important to talk about given some of the circumstances that are happening in the markets. And just by way of background, working with Dr. Clower and his team, we've had a partnership for many years, an enhanced partnership that we've taken to the next level as of last year to work with them to develop a real estate forecasting report, which is now available to our members on nvar.com and our market statistics website. And this is part of that continued partnership, talking about relevant and timely topics that impact the industry and our members. So, okay, Dr. Clower, let's start with interest rate spreads and inverted yield curves. We're all watching interest rates with interest and watching where they're going. Tell us, what is an interest rate spread and an inverted yield curve? And then my secondary question is going to be, why should realtors care or their clients care?
Sure. So basically, the interest rate spreads themselves, it just means the difference in the rates that are paid on short-term, say a 1-year Treasury note versus a long-term bond. And of course, the long-term bond that we're most familiar with in mortgages is a 10-year bond. So it's just what is the differential in those rates between the two. When we talk about an inverted yield curve, that happens is when short-term interest rates actually go above long-term interest rates.
Okay, so what does that mean for for realtors, for their clients, and how might that or might that not affect the real estate market?
Right. So you have to think about it a little bit about what it means about market sentiment. So if we think of it in the perspective that interest rates are a reflection of perceived risk, and if you get to the point where you're saying that you're less certain about what's going to happen in the economy a year from now versus what's going to happen 10 years from now, that's an extraordinary set of circumstances. I mean, because you would think that, like, if you're a realtor and you're selling homes and you think, well, I know what my last year was like, I know what year before last was like, I kind of got a sense of how many homes I would expect to sell this next year. But what are we going to do 10 years from now? I wouldn't have a clue, because you don't know many things about it. So that means that there's a lot of uncertainty in the market when you see that. And because of that, over time, that inverted yield curve has been actually a pretty good predictor of moving into recession. Since 1959, there have been 8 times when there's been an inverted yield curve. In 7 of those times, we actually had a recession within a few months of that happening.
So are we looking at that as a possibility? Should we be concerned about a possible recession sometime soon?
Well, and that's why we're talking about this today, because there's a particular set of circumstances that's going on today that would tell me that it's not likely to be a precursor to recession like it normally would. And that's for 2 reasons. First of all, as you're well aware, the Federal Reserve Bank has been keeping interest rates very low for an extended period of time now, trying to boost the economy coming out of the Great Recession. Well, they are now starting to raise those interest rates on the low end. So the short-term rates are being raised by policy action, if you will, effectively by the Fed fund rates going up. And that's kind of bringing up that lower end, so if you will, the short-term rates. At the same time, the economy is doing very well overall, and there's more money in the economy. So where you're talking about institutional investors that may represent pension funds or big foundations that get donations in from people, they have a lot of money to invest right now, and some of that money is going into long-term bonds. But as the demand increases for a bond, the interest rate paid on those bonds drops, so it's kind of compressing it down. So there's an artificial reason why this gap between short-term and long-term rates are as small as they are. And so I would just tell you that if you're afraid of it being a precursor recession, overall the economy looks to be pretty strong. We're moving. Unemployment is almost at historic lows. Jobs are growing. We're actually seeing some small indications of wage growth in the markets. So it would be one that I think this would be one of those false signals.
So comparatively speaking, 6 out of the last 7 have been a precursor to a recession.
7 of the last 8.
Now there's different circumstances that would be different than what occurred in those 6 out of the last 7.
7 of the last 8.
And their clients should generally kind of just take a step back, relax, and not necessarily worry that this is going to translate into a recession.
And that's exactly the point. So if you have a client, if you're a realtor and you have a client who is very astute or watches, reads the Wall Street Journal every day and is really watching these markets, and they get concerned about this particular metric, I think my advice would be to yes, be cautious, talk to your financial advisor. Don't freak out. Don't, the world's not coming to an end, kind of thing. And indeed, to look at the broader market, that's what's going on in real estate right now, and that's where unemployment is low, but mortgage rates are still at pretty low levels by historic standards, and where you can find available inventory.
Okay, we'll go ahead and stop there. You can go to this video if you want. It's NVAR Market Minutes, and if you search this up, you'll find it pretty easily on YouTube. He just talks a little bit more about the local real estate market in the last couple of minutes. But I wanted to focus on what he mentioned about the yield curve. He did mention that 7 of the last 8 times that we had an inverted yield curve, meaning investors are wanting more return on their money for shorter term debt issuances or maturities than they do long term, it predicted a recession within a few months. He's saying this time, however, he thinks it could be a false positive for 2 reasons. One is that unemployment is really low, and second is that there's more demand for long-term debt issuance, which would tend to, and they're raising, the Fed is raising interest rates on short-term debt issuance. So I wanted to address those by looking at some data to see if what he said was actually correct. And I thank the professor for the explanation of the inverted yield curve and what that typically has meant, and also the reasons he gave for why he thinks it could be a false positive. Well, I wanted to discuss first the labor force participation rate. The professor in the video talked about the unemployment rate, and I've talked in previous videos extensively in my book and also in some further writings on seekingalpha.com, where I've written for the last 7 to 8 years about how the unemployment rate is kind of goosed by the government, and it's not really an accurate predictor of the overall health of employment in the country. And the reason being is that the rate has been manipulated a little bit over time. And there are different measures. They have the U3 and the U6 and some measures they used in the past up until the early 1980s. The U7 are not even being counted for anymore. The basic point that I want to make here is the unemployment rate doesn't count people who have been unemployed for a long time but still want to seek work. They just can't find it. That's what I call structural unemployment. It's unemployment caused by the structure of the economic system that it can't be solved. It's people want to work and they can't. There's just not enough jobs for these people, and that's not counted in the U3 or the U6 number. It is counted, however, in the labor force participation rate, which, as we can see, since the Great Recession has actually fallen. So if you can imagine, unemployment was pretty high during the last recession, and we had 66% of available people or adults working. That's now fallen to 63%, and you can see the trend is lower. You can see here we have lower highs and lower lows. It's sort of gone sideways for about the last 2 years, but it started to trend down again. So this 63% has been a resistance line, and we haven't broken through. And typically when you see a trend like this, that's a precursor to a fall, because this becomes your resistance point. It's not moving up. It's not moving up over a 2-year time frame. And you have the lower highs and the lower lows. This has been the trend. This usually means we're going to have somewhat of a steep fall off. This is a technical indicator. And so that means that we'll have less and less percentage of adults in the workforce. And that's really the true indicator of the strength or the weakness of employment. It's actually much weaker than the unemployment indicators, U6 or U3, would indicate. And so I think maybe that this sort of puts a hole or punches a little bit of a hole into the argument by the professor that we have strong unemployment, because really all that matters is if you're willing and able to work and you can't find a job, that really is a true measure of unemployment and not the U3 or U6 number. Another thing that I wanted to talk about was his other reason for the yield curve inverting, basically saying that there's so much more demand for these long-term debt issuances. So I found a quick chart by Bloomberg which shows the amount of longer-term debt issuance there, and that's defined in this article as 3-year, 10-year, and 30-year issuances issued every quarter by the Treasury. And it says the U.S. Treasury is boosting the amount of long-term debt it sells each quarter. So you can see from the 1990s, to 2000, we actually had a little bit of a fall. And then after the tech crisis, we had a nice little rise, and then a fall right before the recession, and then boom, a big pop-up. And then we've had it fairly steady, although it's been in somewhat of a declining channel, and then it's broken through this resistance line here, and it's starting to trend up. And this is key. So basically what we've had over the last 18 years is for the most part, except for the last recession, we've had a strong increase reaching newer plateaus of long-term debt issuance. And in the recent 7 to 8 years, although we've had a declining pattern, we've broken through a resistance line or a plateau here, and it looks like we're going to punch back up. Now, we'll have to see how long this punch up lasts, but it's clear that the Treasury is issuing more longer-term debt, and looks like they're starting to issue a little bit more. Now, this is after the Treasury basically, or the Fed basically said that they're going to start to reduce the amount of debt that they hold on their books. But overall, a lot of this debt issuance, as I detail in my book and also in some articles I wrote in Seeking Alpha in 2011, and I detail this very specifically, and you guys can go look at that. A lot of the debt issuance that's been by the Treasury has been bought out by the Fed in increasing amounts since the Great Recession. So from here to here, a lot of the long-term debt has been monetized, and what monetized means is the government basically is buying their own debt. So the Treasury issues it, the Fed buys it, the Treasury issues it, the Fed buys it, the Treasury issues it, the Fed buys it. The traditional holders of long-term Treasury debt, China, Japan, countries in Europe, as well as some others, have been falling. In fact, I have a 2011 article in Seeking Alpha, and you can find that by just going to Seeking Alpha and typing in my name and read down my list of articles in 2011. There's an Exploring the Economy series where I plot out charts for 6 major areas of the economy. You'll see one on debt. And in that article, I basically detail how the Fed's been buying more and more and more over time of the long-term debt. We're monetizing our own debt. We're paying for our own debt. And it goes on the ledgers of the citizens of the United States to pay this long-term debt back. So I understood where the professor was saying that, hey, we have more demand for this long-term debt, but it's not the rest of the world that's buying this debt. We're buying our own debt, and it's going on our ledger, and ourselves and our children are going to be responsible for paying off that debt. It's not the general market that's saying we want this debt. Okay, so I wanted to make that distinction. So just because the issuance has gone up doesn't mean that the demand side, that means the supply of that issuance has gone up. That doesn't mean that the organic demand generated in the market is going up along with it. No, the central bank, the Federal Reserve of the United States, is buying much more of it, and the other countries in the market are starting to dump it. And they've been dumping more and more. Recently, there was an article where Russia dumped half of it. Now, they didn't even own 1 trillion of it. They own something like 500 billion, I believe, but they dumped half of it like in a very short time frame. Also, I'm seeing reports of how the Chinese are surreptitiously dumping their treasuries for gold. Those reports have been out the last 5 or 6 years, where they're using third parties to sell treasuries and buy gold, sell treasuries and buy gold. So even though China lists the fact that they have 1.3 trillion in U.S. treasuries, a lot of market participants seeing this sort of under the under the table behavior by the Chinese suggests that they may have dumped up to half of their treasury debt, but they're not saying it publicly because they don't want to create a panic in the treasury market. They still want to sell this debt and try to exchange it for other goods and services such as gold and other things, other currencies, so on and so forth, and not panic the market. So they're still saying that they have 1.3 trillion, but a lot of very reputable market analysts are saying that they don't. So there isn't a lot of organic market demand for long-term treasuries. It's actually being bought by the central bank. So the reason that the George Mason professor gave for saying he doesn't feel that the inverted yield curve is that substantial, I don't think is a valid and legitimate reason. So I think that this inverted yield curve and the fact that it's global means that we're about to have a global recession. And as the professor said in the video, within months, 7 of the last 8 times this has happened since 1959, that has meant within months we've had a recession. Well, it looks like the entire world's about to go into recession in the next few months. A lot of people are predicting somewhere around the October time frame. October has a special meaning that we may get into in further videos. It's not the scope of this video, but I think that probably that October time frame is a good gauge for when we may hit the next recession, and it's going to be global. So inverted yield curve was one of the 2 topics I wanted to talk about today, and another one has to do with insider trading. Okay, so what is insider trading? We're going to change gears from debt to another side of the equation or the ledger, which is stocks. So one of the indicators of the economy not being quite as strong as we think it is, or maybe that we may be getting ready to have our next down business cycle or recession, is insider trading volume. Insider trading, we basically want to track the management of companies across the economy and see, are they buying their own stock of their company or are they selling it? A lot of times when you have extended sales over time across the market, broadly speaking, that's an indicator of a recession, or that's an indicator that the people running these companies know that the economy is not as strong, their companies aren't doing as well, so they're selling their stock at the top and trying to get out of it before it crashes. And they're taking that and they're going to invest in other things, maybe real estate, maybe gold and silver, maybe holding in cash, maybe paying off their debts. Well, as you can see on this chart from Morningstar, about the last 30 days or so, from May 24th through July 4th, look at all of these sales. It has been almost strict on everyday net sales of stock. Now, that's about a 35, 36-day indicator. But you look at that and say, okay, it could be the summer doldrums. It could be people redeeming it to go on vacations. But usually you wouldn't see this large of a drop-off for this period of time. So I did some research and found a little bit longer-term indicator at openinsider.com charts. and graphed it out for a much longer time frame. So this is from about a year, from June 23rd, 2017 to July 3rd, 2018, as you can see here. And you can see in that time that sales have been greater than buys. Sales are in red, purchases are in blue. So for a little over a year, insiders have been selling pretty strongly. In fact, you can see at the end of year, quite a bit of sales. And then it kind of slowed down a bit. And now that we're approaching summer, it's gotten really strong again. And I wanted to see what the chart looked like since the last recession. So if we go back to 2008 time frame, go back just a little bit longer. The last time we actually had, or two of the last three times, you can see here in blue, and here in blue, the peaks. We've only had 3 times in which insider buys across the economy, were stronger for the directors of companies than they were the sales. So since the Great Recession, company leaders have been selling their stocks more than they've been buying. That is a tremendous indicator that since the last Great Recession, insiders do not believe in the relative strength of the economy, specifically of their companies and of the broader economy. And that's a sign that the directors of these companies don't believe that the problems from the last recession have been solved. They're getting out in massive numbers of their own stock. They're taking it and they're converting it into other things for basically the last 10 years. That is a tremendous indicator that the people that run these big companies and see, these broad economic indicators through their companies and see their sales of their companies, they don't believe that the economy is strong, and it hasn't been strong since the last recession. So we can see, as you look back on labor since the Great Recession, it has not improved. It's actually got worse. We have 3 percentage points down, and we're in a downward trend, and we've failed to break through a resistance line, and looks like we're going back down in our labor force participation. And also, look at the sales of stock over that time since a recession. These are 2 big indicators that we never really solved the problems of the last recession. The labor force participation has gone down and has stayed down in a downward trend. Stock sales by insiders have been up almost every month consecutively for 10 straight years since the recession. And the yield curve globally is now inverting. So it looks to me, ladies and gentlemen, like we're about to hit our next Great Recession. I predicted it in my book in 2009, 2010. I said that we haven't solved our problems. I think we're about to have an even bigger recession upcoming. I wrote that 10 years ago. I didn't predict exactly when it would happen, but I wanted to point out these indicators for you guys so you can see where we kind of are. These 2 really, really big indicators that I've given you here. The insider selling and the inverted yield curve around risk on debt and how traders see the market. So I wanted to share that with you guys. Now would be a good time to make your plans. You probably only have a few months before we start to hit the next recession, if these indicators are correct, and historically, they have been. But you only have a few months to really make your preparations. So I would, number one, get out of debt as much as possible. I would even go as far as redeeming some of your more liquid investments and paying down debt. Start with credit cards and any high interest debt, then go to things like auto loans. Then lastly, go to your mortgages, pay as much as you can down. Take some of that and put 5 to 10% into gold and silver. And by 5 to 10%, I mean 5 to 10% of your overall portfolio should be in liquid gold and silver that you have in your possession. And I'm not talking about ETFs or paper gold and silver investments. I'm talking about the real metal you can hold in your hand. And the next thing that I would do is start reducing your monthly spend and start increasing your monthly savings and building up your cash position. You want to hold cash in liquid form. Don't keep too much in your bank. Keep a little bit on hand. Wouldn't keep too much under the mattress because in case someone robs you, but I would keep enough that you can pay 2 to 3 months bills, liquid cash, in case we have a bank holiday and you can't get to your bank and they shut down online banking and you can't pay your bills. I would also increase your food stores, do healthy food stores, maybe buy some seeds. God forbid we go into a global depression like we had in the 1930s. But if we do, you want to have some seeds and other things so you can grow a little bit of your own food and maybe a container garden or just in your backyard. Start to do some of those things. You may only have a few months to do this before the recession hits. Also, do some financial planning with your family. Start to talk to your family about how many incomes you have. Whether you're a one-income family or a two-income family, you may want to talk about what happens if one of you were to lose your job, or potentially both of you in the next recession. What would you do? Spruce up your resumes. If you've got training at work you've been putting off, you want to go ahead and take that now to build up your resume. Get that on your resume, update your resume, so that if something happens, it'll be easier for you to find a job. Get your references sorted out, and also talk about other ways to make money. There's a gig economy going on right now, whether you want to drive for Uber, prepare to do that in case you have a recession, whether you want to make local sales of things that you make. For instance, right now we have a farmer's market going on every week in my city, every Saturday, and a lot of people are starting to come not only from my city but from cities around us to sell their goods and services. And my wife and I have been talking about, what would we do? What could we sell? Could we sell a service? Could we sell a product or good, to help us make a little bit extra money in the event of a recession? I think those are the types of conversations you may want to have at this point, because you don't have a lot of time left before, the recession happens, if these indicators, are as strong as we believe them to be and have been historically. Anyway, that's the current news and analysis for today. This is Robert. Hoping you guys have had a great July 4th week, celebrated your Independence Day, and are having a great week and a great summer so far. Thank you, everyone. Until next time, this is Rob on the Sui Juris channel.